Welcome to Centaur Financial Services Podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Hi everybody, and welcome to the most recent episode of the podcast. I'm Nick Georgopoulos, and I'm joined here with my fellow colleague and advisor, Bobby Byrne. Today we thought it would be a good time to get together and have a bit of a chat around some upcoming changes come 1st of July, seeing as we're approaching the end of this financial year thick and fast. So Bobby, what do you see on the agenda coming 1 July?
Yeah, right. Well, this year, as no different to other years, there's a fair bit going on, particularly for those people in retirement, kind of age pension, age and qualifying for the age pension. In particular, let's start with the minimum pension drawdown rates. So
good. Yeah, so historically, over the last few financial years now, we've had that decreased pension drawdown rate, which essentially means for those in retirement phase within their superannuation, they have to draw a minimum amount based on what their balance is. So past few years, that's been reduced by 50%, but as of 1st of July, we're seeing that come back to the full amount. So it's age-based on that percentage, so it's different for everybody. But of course, there's probably a few things to think about as we approach that to prepare for that from a portfolio perspective.
Yeah, for sure. So obviously, with those drawdown rates now increasing again, we want to make sure we have enough cash to fund the next year's drawdown, especially if it's going to be double what it has been. So probably see some changes coming up in that realm, especially now cash is yielding a bit of a better return. But just to kind of swing around and give you an indication of what those drawdowns are going to be. So as Nick said, age-based. So right now, if you're between age 60 and 64, it's 2%, but that goes back to the normal 4%. 65 to 74, it's going to 5%, 75 to 79, 6%, then it goes in 5-year blocks, 7%, 9, 11, and then 14 after you turn 95, I believe. Yeah. So, yeah, it's a significant increase. So if you're on the minimum now, just expect that coming up in July. That's going to be your first payment's going to be double what it was in June.
Yeah, and it's a new world, right? Because with those 50% reductions, people started to get used to spending that income. It works well. It comes into their account. They're able to spend it, and that's their living expenses sorted.
Yep.
But with that additional amount coming in, we see, okay, well now we're spending a bit more from the retirement balance, but we might have a bit more cash that's sitting in the bank accounts as well. So just something to highlight.
Yeah, definitely.
I guess the other major one, which is quite exciting, is the changes to age pension.
Age pension, yeah, that's right. So on that one, this is another potential increase in cash flow for everyone on top of the drawdown rates. So this could be an interesting kind of time, and actually circles into a strategy we'll touch on later or in later podcasts.
Yeah.
So essentially, age pension, your income and your asset tested, either one, whichever gives you the lowest amount, you'll be tested under. Most people, that's the assets test. So essentially, the amount of age pension in terms of the dollar amount you receive on a fortnightly basis isn't necessarily changing. It's the thresholds that are changing, which could dictate how much you get per fortnight.
Yeah, really good. So basically, as for a part pensioner, it means they might see a bit of an uptick in what they're receiving on a fortnightly basis.
Yep.
But also those that historically have been just outside of that asset threshold by having too much in way of assets may now be able to start receiving some age pension and the benefits that come along with that as well.
Yeah, for sure. So for homeowners, both singles and couples, that's about $30,000 extra, $32,000 extra in assets you can now have and receive a bit of an uptick there. For non-homeowners, it's about $40,000 additional in assets you can have to be eligible for age pension or ineligible for age pension. I think one thing to note around that is a strategy that's coming into the fold now with these increases is also lifetime annuities are coming back to the fold.
Yeah.
It's got a bit of a higher interest rate or yield on those now. Plus they're concessionally tested for asset income versus for age pension. So that's another strategy we've been looking at a lot lately that's coming back. And that kind of we'll review that in the coming 6 to 12 months as well.
Yeah, absolutely. And I mean, all those rates around what's changing in regards to age pension, that's all going to be on our website as well. So want to have a look at some more information in regards to that, great resource on our website there. But on the agenda of things that are changing 1 July, if we look from the superannuation side again, the transfer balance cap, so that's going to be indexed again this year. What's that moving to?
Yeah, right. So transfer balance cap. Well, right now it's at 1.7 million.
Yep.
It's going to 1.9 million.
Good.
So this is generally indexed in $100,000 increments. Because of inflation's been so high, it's actually having a double indexation benefit there. So what the transfer balance cap is the amount you can have in tax-free pension phase, what we call it, where you're drawing an income.
Mm-hmm.
So that's significant. In terms of the actual benefit of the $200,000, if you've already triggered your transfer balance cap in terms of you've started an account-based pension in the past, you will not get that whole benefit. You get the proportion that you haven't used under the current cap of 1.7 million, that will be applied to the indexation, which you'll then receive. So that's a bit tricky. So now on, everyone's going to have different transfer balance cap amounts. So that's going to be something you need to monitor. And you can always chat with your advisor about to see.
But it does open up a little bit more around contributing to super. If you were thinking, okay, well, if I start to contribute even more into superannuation, I might not have as much as I would like in that tax-free environment. So what's the point? So it does open up that a little bit. And we're probably almost 12 months through the new contribution changes as well in regards to the work test, which not everyone's aware about. It has been in place for about 12 months, but the age in which we can contribute to super significantly increased 1 July 2022.
Yeah, right. Okay, good point. So on the work test, they essentially abolished that for non-concessional contributions. So that is to say after-tax contributions. So essentially that used to be 67. Now they got rid of that, so you can contribute non-concession to super up to age 80 or 75 rather, which is when you are cut off from contributing to super under most types of contributions. From then on, there's a couple of nuances there with downsized contributions and the like. But now essentially, if you've got cash in your personal name that previously you weren't able to contribute to super because you were over 67, that's now changed. So now you actually can get that into the super environment. So there's a couple of strategies we've been playing with around that, with people with cash that weren't able to get that into super before. They now can, which goes into the portfolio, which gives a larger pool to fund the same income stream. So something we're looking at.
We do a lot of work around essentially flushing out the taxable components of superannuation. Without getting too technical, with that increase in age, there's actually more opportunity to basically look at withdrawing and recontributing back to super to reduce not the tax that's paid between a death benefit between spouses, but rather an adult to an adult child, essentially. What tax would be paid on that estate can quite significantly be reduced. So a lot of opportunity now with that increase in contribution age.
Yeah, for sure.
Great.
What else we have? Super guarantee. Nick,
yes.
What's going on there?
11% is the new number. So this has been ticking up each year. So year to date, super guarantees, so the amount of superannuation your employer is paying based on your salary currently is 10.5%. That increases to 11% from 1st of July, which is really great because having that fund, those funds going into your super account over a lifetime at 11% is really supporting that long-term retirement for employees.
Yeah, for sure. It's supposed to go to 12.5, I believe.
That's the plan. That's where it's going.
Yeah, right. It's that's a significant amount of your income going in. So
it is.
It's going to be an interesting world, especially with changes around potential caps, $3 million cap that was discussed in the last budget, which we won't get into today. But questions on that, shoot them through.
Maybe a future podcast.
Yeah, potentially. I think that's all changes that we need to run through, Nick.
Yeah, that seems to be everything. There's not a whole lot come 1st of July, but I'm sure if there is any questions that pop up, please reach out to us. But until next time, thanks for joining us.